And it's great to have you because I know you are one of those that didn't think this market was going to rally, and I want to hear what you have to say. It's up 27% year to date. You thought it was going to be flat for the year. Are there any fundamental changes that you think has supported this rally, or are you still very cautious?
I would say that the market has changed, and we've got to look at all the dynamics that have driven the market to the point where it is today. First things first was that we got very good corporate numbers, which was a concern for everyone at the beginning of the year. Interest rates were rising. It was a difficult environment. We were not sure what was going to happen to the currency. And it looks like the central bank has sort of managed all of those issues. If you put that into perspective, you also look at what has happened in Europe. And that has created a significant opportunity for emerging markets. You look at South Africa. South African index hit an all-time high. Right. Last week as well. So the reality is that there is concerted flows out of developed markets. I think if you look at the developed market index,
so you think that's the key shift?
I think there's a fundamental shift in terms of if you look at the biggest drivers of the market in the last 3-4 years has always been FDIs. It's always been foreign portfolio investments coming in and people buying up, stocks that had been beaten down. Now, the banks have done very well this year, profitability across board. Some of the big corporates who are the key drivers of the market have also done very well. If you put it beside the fact that there's a lot more confidence around the currency, even though I think it's misplaced. I think over time, if there's any, the shock still remains around the oil price. If oil prices suffer any form of significant declines, then you're going to see that currency just go.
I think that's one of the points that the central bank has been making, and we shouldn't get ahead of ourselves. Yes,
absolutely. I think that,
or maybe because of
I think that the reality is that our legislators need to be educated around the fact that, look, we can get exuberant about all of this, but the reality is that we can't just assume that oil prices are going to continue to remain where they are today. And this is a country that has suffered production shocks in the past, where we've seen production drop from 2.6 million barrels to 1.9, 1.5 in some instances. So you've got to put all of that into perspective and say, just look, let's keep it at the 75. Let's get some level of fiscal discipline into the system, because the biggest shocks to the Nigerian economy today still remains fiscal indiscipline. The monetary policy has been such that it's kind of kept things in check. So no one is overtly aggressive and all of that. But from a fiscal point of view, you've got to keep asking those questions. The state governments get this money, the local government gets these monies, and they just blow it. And you've got to ask yourself, is it sustainable in the long term? And there's so much resistance to the sovereign wealth fund, and it's just something that we have to keep educating people and say that, look, don't just be sentimental and emotional when you make these comments. You've got to think about the long-term impact of the decisions that we take. And we're still recovering from the 2008-2007 period. We're quite excited about the index reaching 26,000, approaching 27,000, but when it's coming from 66,000.
True.
In March 2008.
Still has some way to go.
It's still got quite a bit of, another 100% upside. And I don't think it would get there, at least not in the near future. But the key things for us are that, look, what has happened is there's been a lot of cash flowing into the market. It probably accentuates the challenge that we've always had in terms of the depth of the market itself isn't exactly huge. Volumes, the biggest volumes we've seen in 3 or 4 years probably happened on a day last week. Right. But until we see those kind of volumes, and hopefully with the market makers becoming more active in creating that demand and supply balance, then you're not likely to see this being sustained in the long term. You would see this, rallies that people buy into them. The retail investors, I say that the retail investors are fundamental to a sustainable rally of the Nigerian market. Now, I think that with what we've seen in 2012, you might start to attract those retail investors. I heard Michael talking about the mutual fund and how people need to start to, accept that mutual fund is actually an alternative to the market. And it's actually a good alternative because you've got a portfolio manager who's able to help you spread your risks. Right. But I think that over time, until we get the retail investors whereby they're coming back into the market, until we see an active capital market, not just by the secondary part I'm talking about now, but the primary part of the market. My primary part of the market is dead.
I was just going to ask you, when do you think we may have a public offering? I mean, we haven't heard of an IPO in the last, 3 or 4 years. Do you think we'll have one next year maybe?
I think the next year could be an interesting year.
I think that would be a key segment.
And that would be key. That is fundamental for me, because then it means that the capital formation role that the capital market is supposed to play becomes one that it becomes active again. Right. And that is key for us. I think you would see pockets of transactions being done. I'm aware that the one was announced that they're going to do. Those are rights. But those are rights offering. So
we need a public offering.
No one is trusting the market enough to go and do a public offering. But I think that by 2013, you will start to see a bit more confidence coming into the system. I think that the hawkish stance of the central bank will probably start to thaw a bit. Yeah. And you can then start to hope that, look, you know what, if we're managing inflation and the currency hopefully remains, within this band that it's been trading, then people can make long-term plans. And you can only do long-term investments when you can make long-term plans. And I think then you can start to see some gas behind the rally. But for me, you do an analysis of what's been driving the market. It's still the big tickets. That still tells you that there's still a flight to quality. Right. And that flight to quality is going to continue. It's when the peripheral players, the insurance companies haven't moved.
They haven't moved yet.
Yeah, they're still 50 kobo. A lot of them. So until you start to see those sort of, vehicles starting to attract investment, not for sentimental reasons, but simply because people can now see that there's actually value in these stocks, then I can start to rest easy and say, look, you know what, perhaps this is actually long-term and this is sustainable. But
you made a point that it's a liquidity-driven bull run that we're seeing. But how much more liquidity can we see? Clearly, we know QE3 is in play. We've seen emerging market like Nigeria benefit from that. Yeah. But what about locally? Of course, many people are talking about the forbearance that the stockbrokers are looking for. Do you think we may see that soon? Do you think that we'll see a lot more liquidity going into this market going into the rest of this quarter?
I think that we will see significant liquidity. I think that one of the fundamental players in the market that had stayed out of the equities market were the PFAs.
Right.
I
hear there's a small change in sentiment there.
There definitely has to be a small change in sentiment. I'm going to be upset if my PFA comes to me at the end of the year and says, well,
you didn't participate in this rally because you're conservative.
Because I've always had a challenge with the PFAs in the first place to say that the average age of your contributors to the funds and the capital allocation or the portfolio allocation theory that these guys are using are totally at variance. The average age of your contributors is between 30 and 35, and you've got 80% of your contributions in fixed income. For me, it just makes no sense. I'm willing to take those risks now because I'm working for the next 25, 30 years. So that's what we want to see. The PFAs come back into the market. Of course, I don't want you buying just any stock because it's got a PLC behind it. But in a very orchestrated way, start to play the market, start to realize that there is value in this market. Our price earnings ratios are still, relatively low, compared to the rest of the market. So there is some gas behind it, and that's what I want to see portfolio managers looking at and saying, right now, maybe you should actually be overweighting your equity.
Okay, so the market exposure is up almost 28%. Let's round this up. Your thoughts on where it could end the year? Do you think we'll be about 28 or above 30? It's always difficult to call. It
is difficult to call short term.
Where do you see it going?
I think that I expect that we would see the market continue to trade upwards till the end of the year. The risks, obviously, for me, are always to the upside. It's a function of what the central bank does. It's a function of where oil prices remain. Right. And it's also a function of what happens in the global economy. If Europe all of a sudden gets their acts together, then that there's going to be capital outflows from Nigeria. So for me, it's the entire package that will determine where we close the year. But it's a bit difficult to call. But I think that the sentiments today are such that you could see the market continue to show these very strong gains. And fundamentally, a lot of the companies are stronger than they were 5 years ago. 4 years ago. So I can see people reappraising the valuations of where these companies should actually be trading. But the sentiments for me is always that all the variables have to gather together and ensure that the market continues to sustain this.
Femi, thank you. Thank you so much for joining us on the show today.